When I was a younger kid, I thought diversification meant having more trades on more symbols, flashing on the screen, more charts to watch, and I wore that chaos like a badge of professionalism, convinced that spreading myself across markets made me safer, when in reality, all I was doing was multiplying the same mistake in different places. True diversification is one of those concepts that sounds simple until the market forces you to learn it the hard way, and I didn't truly understand it until I watched a well-diversified portfolio bleed all at once, teaching me that diversification, without understanding correlation, is just concentrated risk in disguise. In my early portfolio days, I traded stocks, indices, and futures, believing I had built something robust. But when volatility spiked, everything moved together, and my losses stacked up faster than my mind could process them. That was the moment I learned the first real rule of portfolio construction. Diversification is not about how many instruments you trade. It's about how many different ways you can be wrong at the same time. A diversified trading portfolio isn't built by adding trades. It's built by adding independence. Independence of strategy, independence of time, horizon, independence of behavior, under stress. Over the years, through dot-com aftershocks, the 2008 collapse, and the violent compression of the COVID cycle, I began to see portfolio construction less like collecting tools and more like designing a system that could absorb shocks without collapsing. I stopped asking whether a trade looked good on its own and started asking how it behaved relative to everything else I was doing. Did it win when my other strategies lost? Did it lose differently? Did it respond to volatility, expansion, or contraction? Those questions mattered far more than entry precision. One of the most important shifts I made was separating strategies by time frame. Short-term trades fed off volatility and momentum, while longer-term positions thrived on structure and patience. They didn't just produce different returns, they produced different emotional responses. When short-term trading felt noisy and frustrating, longer-term positions provided stability. When longer-term trades stagnated, short-term opportunities kept my edge engaged. That balance wasn't about returns, it was about psychological diversification, something most traders ignore until their emotions sabotage an otherwise sound portfolio. Then came diversification by market condition. I built strategies that performed well in trends, others that survived ranges, and a few that existed purely to protect capital during transitions. I learned that no single strategy deserves permanent capital. Capital must flow toward what the market is currently rewarding and retreat from what it is punishing, and diversification allows that flow without forcing emotional decisions. Instead of abandoning strategies when they underperformed, I learned to downsize them, letting them breathe until conditions rotated back. That approach saved me from constantly reinventing myself and kept my portfolio structurally intact through multiple cycles. Correlation management became a daily discipline. I stopped thinking in terms of trades and started thinking in terms of exposure buckets. Risk-on assets went together. Risk-off assets clustered. Volatility linked things I once thought were unrelated. I learned to cap total exposure across correlated strategies, not because any single trade was dangerous, but because together they could overwhelm my risk tolerance. This portfolio-level thinking was uncomfortable at first because it forced me to pass on good-looking trades, but that discomfort was the price of longevity. The portfolio didn't need more opportunities, it needed balance. I also learned that diversification is dynamic, not static. What is uncorrelated in calm markets often becomes highly correlated in stress, and that's where portfolios fail. So I began stress testing mentally, asking what happens if volatility spikes, if liquidity dries up, if correlations converge. Those scenarios didn't make me paranoid. They made me prepared. I learned to hold cash as an active component of diversification, not as unused potential. Cash reduced correlation, reduced emotional pressure, and gave me optionality when real opportunity emerged. Over time, diversification reshaped the way I measured success. I stopped judging my performance by individual trades or even individual strategies, and started judging it by the smoothness of my equity curve, by how well my portfolio absorbed losses without forcing behavioral mistakes. Some months, one strategy carried the load. Other months, it stepped aside while another took its place. My job wasn't to predict which one would lead next. It was to maintain a structure that allowed leadership to rotate without breaking the whole system. And here's the part most traders miss. Diversification isn't about maximizing returns. It's about minimizing regret. It reduces the emotional damage of being wrong at the wrong time. It keeps you engaged without being overexposed. It allows you to survive periods where your favorite approach goes cold without questioning your entire identity as a trader. As I sit here now, decades into this career, I can say with certainty that no single strategy kept me alive. No single market made me consistent. No single edge carried me through every cycle. What did was a portfolio built with humility, one that assumed I would be wrong often, and designed itself accordingly. And that mindset, accepting imperfection and building around it, is what separates trading portfolios that last from those that eventually collapse under the weight of their own overconfidence. Because a diversified trading portfolio is not a display of intelligence. It's an admission of uncertainty. And once you truly accept that uncertainty as permanent, you stop trying to dominate the market and start organizing yourself to coexist with it. And that shift is where real stability begins. Because stability in trading never comes from being right all the time. It comes from structuring your exposure so that being wrong doesn't end your career. And that understanding only fully settles in when you stop thinking like a trader chasing setups and start thinking like a risk manager, building something meant to endure something, designed to bend without breaking, something that can survive not just the trades you expect, but the ones you never see coming. And that realization marks the point where diversification stops being a concept and becomes a discipline, one that quietly works in the background long before the results ever show up on a statement. And it's only then that you begin to understand that building a diversified trading portfolio isn't about adding more. It's about aligning everything you do so that when the market changes, you're already positioned to adjust without panic when conditions shift. Because once diversification is built correctly, it does something subtle but powerful. It removes urgency from your decisions. In the later years of my career, I noticed that the best portfolios didn't feel exciting day to day, and that was the point. When one part struggled, another carried quietly. When volatility exploded, exposure contracted automatically. When opportunity dried up, capital rested without pressure. That balance gave me the mental space to think clearly, to respond instead of react, and to let probability do its work over time. I learned to review my portfolio, not by asking which strategy made the most money, but which one reduced stress, smoothed drawdowns, and allowed me to stay disciplined when the environment turned hostile. Some strategies earned their keep not by producing returns, but by offsetting losses elsewhere. And once I accepted that role, I stopped resenting them during quiet periods. I also learned that diversification must evolve with you. As my experience deepened, my tolerance for noise changed my time, horizons shifted, and the portfolio adapted accordingly. I trimmed strategies that demanded constant attention and leaned into those that rewarded patience, not because they were superior, but because they fit who I had become. That alignment mattered more than optimization. Over decades, I saw traders with brilliant single edges rise fast and fall hard undone, not by lack of intelligence, but by lack of structure. When their one approach stopped working, they had nothing to lean on. Diversification gave me resilience. It let me be wrong in parts without being wrong as a whole. And that kid is the real value. A diversified trading portfolio doesn't eliminate pain, it distributes it. It keeps any one mistake from defining you. It buys you time, and time is the rarest currency in this business. As the years passed, the portfolio became less about chasing returns and more about protecting the conditions that allowed returns to compound, clarity, discipline, and emotional stability. And if there's one truth I want you to carry forward, it's this: diversification is not about hedging fear, it's about honoring uncertainty. The market will always surprise you, but a well-built portfolio turns those surprises into manageable events instead of career-ending moments. And if this story helped you rethink diversification, not as a checklist, but as a philosophy, take a moment to leave a comment with your thoughts. And don't forget to subscribe, so I can keep sharing the lessons the market spent a lifetime teaching me.